In this presentation, we're going to record a deposit from the owner using bank feeds. In other words, we're going to have the bank feeds, record the bank feeds, or import the bank feeds. We'll have a deposit, which we're going to determine is from the owner. We're going to record or include that transaction then in our financial statements. Here we go now with Xero Now. Here we are in our Triple G company dashboard. We're going to be opening up our financial statements, going to the accounting dropdown. We're going to be opening up the old balance sheet report. And once that opens up, we're going to go to the tab up top, right click on that tab up top, duplicate it. Then we're going to go back to the prior tab. We don't really need the income statement this time because we're not going to be affecting the income statement. So let's not do that one. Let's go to the accounting dropdown and just go down to the reports and open up the bank reconciliation report, which is under the accounting section. We want the bank reconciliation summary. Once that opens up, we're going to go back up top one more time, and well, maybe not one more time, but again, and we're going to duplicate that tab back to the balance sheet on the right hand side. Let's adjust the dates now. We're going to go up to the date and bring that to March. That's what we're working with, March 31st, and update that report. Then we're going to go to the bank reconciliation. We're going to change this to our checking account. And we're going to put the date here once again to the end of March, that being March 31st. Update that report. Then we'll go back to the left. We're going to go to the accounting drop down and we're going to go to the bank accounts. So within the bank accounts, we're looking at those bank feeds, of which we have one remaining. So we're going to go into the bank reconciliation where we've got that last one to deal with. I'm going to hold down control, scroll up just a bit, so we're at the 125 on the percentage. And this last one is another deposit. And this is the other scenario that we might have if there's a deposit other than a customer deposit. Maybe it came from a loan, which we did last time, or maybe it came from us, the owner. So we're going to assume this came from the owner. The same principle applies. If you're going to assume that all deposits are from the customer, then you got to make sure that you pick up those exceptions, which might be a loan, a deposit resulting from a loan, or a deposit resulting from the owner putting money in. Now, hopefully, as the business proceeds, the owner will not be putting money into the company. The company will be generating money from customers, and the owner will be removing that money in the form of draws for their own personal use. However, in cases where we're starting the new business or cases where we're trying to expand, then we may well have instances where we're putting money into the system. Same thing applies. We don't want to be paying taxes basically on the revenue from the money that we're putting into the system. Therefore, make sure you don't put it into what they're suggesting here based on our prior transaction, or at least what they would normally suggest, because normally we would put all the deposits into the income account, and they would be suggesting here, hey, this is a deposit, that's all I know, that's all I have to go on, and that would be going to a deposit. Now here it's obviously going to the loan account because that's the last one we entered, but most of the time, most of the deposits are we're just going to assume all deposits are going into income, and if we just kind of went down there and checked them all off, they would go into income. So we got to say, okay, that's a large deposit. It's a round number. Looks like something funny's going on, possibly. And then we look into it and say, oh yeah, that's the money we put in to the system. We don't want to be putting it to income. So we're going to say this isn't coming from Chase. I could say owner as the contact. And then the other side is going to be going to some type of capital or equity account. So I'm going to go down and see if we have an appropriate equity account. So we're in the equity section. Here's the equity type of account. So these are going to be balance sheet accounts, not income statement accounts. Not going to affect net income then. So we have the capital account. We've got the owner's capital investment. So that one looks appropriate. So that's us putting money in the owner's capital investment. So I'll go with that one. That's the one we're going with. We could put a description of, we're putting money in for whatever reason if we so choose. I'm not going to here. And that's going to be it. So I'm going to add this and then we're going to match it. So I'm going to go ahead and say, let's say okay. And that'll match it out here. So now we've added it and matched it. And it says great job because that was the last one that we had to record. Let's see, in order to reconcile, but we're not done yet because we still haven't included the beginning balance. So we're not quite done yet. So they're giving us a good job, which is nice, but it's a little early, a little premature. So now we're going to go over to the balance sheet, see what happens. We're going to be updating the balance sheet here. Then, of course, in the checking account, we now have good cash in the checking account. That makes us feel good after having it showing as overdrawn for such a long period of time, which is a bit disturbing. It's not correct. It's not correct yet, but at least it's a positive number in cash. So then we got the $65,000 down here in the owner. It's a money received. item, notice it's the same item as the customer deposits, but it's a different account. These ones on the other side went to income. Up here, it's a deposit or money received from different sources, either the bank or, in our case, this time with the owner deposit. The other side then is going to be going on down to the equity section. It goes directly into the equity section down here. Now, the earnings, the current year earnings are basically like the net income that are included in here that will roll over to retained earnings. And then we're tracking our investment, the money that we put into the company separately in a separate equity account in this case. That's where the $65,000 is. No effect on the income statement. If we look at the bank reconciliation, then we have the bank reconciliation. Once I select update, this 19,917 will change to what is on the balance sheet, which is currently the 84,917, and this last amount here will disappear. Let's go ahead and update that. Updating that item, we're going to say, all right, there's the 84,917. That's correct. No reconciling items. So now you'd say, well, if there's no reconciling items, this is the book balance, no reconciling items. This should match the statement balance, which it does not here. Why? Because we haven't included the beginning balance. We just included the activity. So this is often what you have to kind of think about when you first start the system in a new system or a new company, which you already have a bank account set up for. So we're gonna have to think, well, how can I add the beginning balance? So that's gonna be needed for us to get on track here. Why aren't there any outstanding balances? Is that normal with a bank reconciliation? No, it's not normal. Why isn't it normal? Because usually we don't get all of our data directly from the bank. Usually we enter the data and then we use the bank to double check, and therefore we will have things like outstanding checks that we wrote that haven't cleared the bank, and possibly outstanding deposits that we put into the bank but haven't yet reconciled. We don't have that here because we're completely dependent on the bank. We waited until they cleared the bank. So really the reconciliation, all the reconciliation is doing under a complete cash basis system on which we're completely dependent on the bank, waiting for things to clear the bank. All the reconciliation is doing, it's really important to do this, but it'll be a bit different. We're double checking that we entered all the transactions correctly and that we haven't double entered transactions. That's basically what we're doing. And by doing this right now, this isn't enough, notice, for us to verify that, because I need to double check this to a periodic statement balance. So I still need to kind of reconcile it to the statement balance just to see that there's not problems that like the one we currently have now, right? This still isn't reconciled. The reconciliation has to match out to the statement balance here, and it doesn't until we add something. So that's not quite done yet. If we go back to the first tab, then if we go to the bank statement information, I'm going to go to the bank statement information and scroll on down. We should have everything that we have imported now has a green reconciled item. They've all been reconciled at this point in time, which is excellent. And the one we just did was the 65,000. That's the one we were looking for. And then, I believe that's the one. And then the accounting transactions, of course, we added this accounting transaction of the 65,000 and reconciled it at this point in time. That's it for now. Let's get out of here.